You're listening to AM Now, an Accounting Matters podcast. I'm Adam Olsen.
And I'm Matt Fisser.
This week, we're bringing you updates from the FASB, the IASB, several key sustainability matters, and something SEC registrants may need to keep in mind in light of recent events.
Starting us off, the FASB recently completed its Conceptual Framework, a decades-long project in the making that they have finally been able to draw to a close. In doing so, a Chapter 6 was added to FASB Concept Statement Number 8. This new and final chapter focuses on measuring assets and liabilities recognized in financial statements. More specifically, it describes the entry price system and the exit price system, which they deem as the most relevant and representationally faithful measurement systems, as well as factors to consider when choosing a measurement system. A copy of the new chapter is live on the FASB's website for your late summer reading list.
Sounds riveting. But staying with the FASB and an issue we previously covered on the AM Now podcast, the FASB did make tentative decisions around an EITF issued centered on induced conversions of convertible debt instruments. FASB staff were directed to draft a proposed accounting standard update with a 90-day comment period. And last week, the board reconvened on the matter to review stakeholder feedback received on the proposed ASU, and in so, they affirmed their decisions.
To start, in order to apply induced conversion accounting, the inducement offer must preserve the form and amount of consideration issuable pursuant to the original conversion privileges. The board will also clarify that determining whether the form and amount of consideration is preserved should be performed as of the offer acceptance date. Additionally, if there has been no substantial modification of the convertible debt in the year leading up to the offer acceptance date, the entity should use the terms of the convertible debt as they were a year ago to determine if induced conversion accounting can be applied. Finally, the board affirmed that induced conversion accounting can be used for all convertible debt instruments with a substantive conversion feature at issuance, regardless of their current convertibility. For instance, debt instruments contingent on an event are within the guidance's scope if the conversion feature is substantive when issued.
Yeah, and these amendments can be applied prospectively or retrospectively and will be effective for fiscal years beginning after December 15th, 2025 for all entities. Early adoption will be permitted as long as the entity has also adopted ASU 2020-06. FASB staff will begin drafting a final ASU shortly.
And rounding out our FASB news this week, the board made a tentative decision on another EITF issue, determining the acquirer in the acquisition of a VIE. Rather than simply concluding that the primary beneficiary should always be the accounting acquirer of a VIE that meets the definition of a business, the board agreed with the EITF that an entity should apply existing guidance when identifying the acquirer. Specifically, this means paragraphs 805, 10, 55, 12 through 55, 15.
Yeah, and as a reminder, this guidance is used when an acquirer cannot be identified based solely on the outstanding voting interests. Some of the factors outlined here include consideration of the relative voting rights, the size of any single minority voting interest, composition of the board or other governing body, composition of the executive management team, terms of the exchange of the equity instruments, and even the size of the combining entities. The FASB did not provide a hierarchy to explain how to assess these various factors, effectively concluding that no single criterion is more significant than any other. Therefore, the determination of the accounting acquirer will require the exercise of professional judgment based on the evaluation of all of those factors in the aggregate.
These amendments should be applied prospectively, and early adoption is permitted. FASB staff will begin drafting a proposed ASU with a 45-day comment period.
And switching to the international counterpart of the FASB, the IASB, as part of their regular maintenance, issued targeted improvements to IFRS standards. Volume 11 of its annual improvements includes changes to the standards covering first-time adoption of IFRS, financial instruments, consolidated financial statements, and statement of cash flows. These changes are primarily meant to clarify wording, make minor corrections, and simplify and remove any inconsistencies. These amendments are effective for annual periods beginning on or after January 1st of 2026, and again, early adoption here is permitted.
Up next, we have a series of sustainability reporting updates to touch on. One interesting anecdote we recently saw comes from the Center for Audit Quality, which recently published a report on the state of ESG reporting among S&P 500 companies for 2022. In their report, the CAQ found that ESG reporting remains prevalent for companies with 98% of companies disclosing some level of information. Further adding weight to the significance of this information for stakeholders and investors, 70% of these companies also obtained some degree of voluntary assurance over their metrics. While greenhouse gas emissions has historically been the metric many companies subjected to voluntary assurance, the report also found that other metrics are being included in the scope of that work.
The report also identified other findings related to different standards and frameworks used. In regards to standards, the report found that U.S. auditors followed AICPA standards, while non-U.S. auditors allowed IASB standards. This inconsistency in standards can raise questions about the reliability and comparability of ESG information across different companies, particularly when non-public accounting firms are used as assurance providers, as application of all of the requirements of those assurance standards may not be met.
In other sustainability news here domestically, California Governor Gavin Newsom recently proposed delaying the implementation of California Senate Bills 253 and 261 by 2 years, from 2026 to 2028. As you might recall from earlier episodes, Senate Bill 253 mandates large companies with annual revenues over $1 billion doing business in California to publicly disclose their greenhouse gas emissions, which are categorized into 3 scopes. Senate Bill 261 requires companies with annual revenues over $500 million to issue reports on their climate-related financial risks and the measures they are adopting to mitigate these risks aligned with requirements of the TCFD.
The California climate bills were signed into law in October of 2023, leaving implementation of the laws as next steps. However, lawmakers and the California Air Resource Board have not been able to finalize the details, making the implementation deadlines challenging to be met, according to the governor's office. The authors of the bill, however, do not agree with the proposed delay and intend to challenge the governor's proposal. We will monitor this closely as more developments come. In the meantime, we encourage impacted companies to continue to focus on their compliance roadmap.
Our last piece of news comes in the wake of the recent CrowdStrike server outage impacting numerous companies across the globe. The server-related outages last week could have significant implications for public companies subject to the SEC's new cybersecurity disclosure rules. For example, this situation does raise questions about whether these incidents constitute cybersecurity incidents under Item 105 of Form 8K, according to the new cybersecurity disclosure rules. While CrowdStrike's defective update, which impacted customers using certain Microsoft operating systems, was not due to malicious activity, it did cause significant operational disruptions. The SEC's definition of a cybersecurity incident includes any unauthorized occurrence that jeopardizes the confidentiality, integrity, or availability of information systems, even if accidental. This broad definition implies that accidental technology outages could be reportable if they materially disrupt operations.
And as a result, public companies affected by this incident should begin to evaluate whether disclosure and filings may be necessary in light of these circumstances. This includes assessing compliance with policies to determine if the impact is material and if any reporting is needed, conducting risk assessments and gap analyses to identify any system deficiencies, including those involving third parties and disaster recovery practices, updating potentially risk factors and disclosures about system downtime and third-party reliance, considering discussing the material impact as well of the update in management's discussion and analysis section of their filings, and evaluating the implications for internal and disclosure controls and procedures. And that rounds us out for this week. For a deeper dive into what's trending in accounting, finance, and sustainability reporting, check out our other podcast on the Accounting Matters feed on your preferred listening platform. Again, I'm Adam Olsen.
And I'm Matt Fisser.
From your friends at Embark, thanks for listening to AM Now.